All right, we're back. We're covering redeeming versus non-redeeming qualities, and we're going to item number 3, and that's the buyer's equity. What does the borrower have to lose? When the borrower purchases, and this gets back to down payment. This is one of the reasons why we encourage to at least 10% down payment or higher. Usually we try to push for 15 to 20% if we at all possibly can, because they have more to lose. And if they have more to lose, it's less likely that they're going to default on the loan. Equity is also gained over time by making a number of payments. And as a result, all right, as they pay off the loan, the equity position they have is greater. If the borrower pays 15 years or 10 years of payments on this particular note when you have the opportunity to purchase it, and those payments have been on time, or even if there's been a couple blips in there, all right, but if they've been on time, they've put 10% down, all right, they're probably looking at it, at this point, at least a 20 to 25% equity position. They've got a lot to lose. What do you think the likelihood is that they're going to continue to pay on that loan? It's very high. Now, obviously, anything can happen, but you're playing the percentages here, and that certainly would be in your favor. What is the current UPB to valuation? That's going to be an important. What's the current unpaid principal balance to the valuation of the property? All right, there's your when you're looking at it, there's the valuation, or there's the equity position for the borrower, but also now you're looking at your ITV. What's your investment to the value of that? That gives you a much larger cushion to protect your interests. Another thing to keep in mind is where are we at in the current market cycle? Are we on the upward swing? All right, are we on the downward swing? As at the recording of this discussion, we're at the peak of the market. So we, in our situation right now, we're actually hedging back a little bit on the investment to value, the ITV, because we anticipate that those values are going to go down over the next couple years. So we want to make sure we have plenty of equity if the valuation drops to protect us in case the loan would happen to go bad. Another thing would be what's the emotional equity, all right, of the borrower, all right? The buyer's emotional equity. If they've paid on this for 10 years, the likelihood that they're going to continue to pay on this loan is very, very high. They have emotional equity into it, and quite honestly, many times that's even more important than the actual monetary equity that's in the home. This has become their home. This is where they're living. This is where their kids are growing up. There's memories, positive memories there for many people. And then the other thing is just your investment to what's in your investment to balance. That's kind of a little bit of looking at the percent of discount is what you're looking at there in that respect. Another factor, number 4 in this scenario, would be looking at the loan terms. All right, so we've talked about the borrow, we've talked about the collateral, we've talked about the buyer's equity. Now we've talked about the loan terms itself. All right, what about the loan length? All right, a longer loan, all right, allows for more partials to be paid, but oftentimes the payment may be lower as a result. What's the interest rate? Buyers on the secondary market, the face value, the face value or the coupon value of the note itself really has no bearing whatsoever upon what the type of yield you as the buyer would be wanting to get. Well, how this plays out, if you have an interest rate that's only 4 or 5% and your buyer on the secondary market's looking for a return or a yield of 10 to 11%, that means you're going to take a much greater discount on that note. So it behooves you to be creating notes that have higher interest levels, all right, because that's what the secondary market requires. The other thing is, if you're borrowing money and doing a wrap mortgage, creating notes, all right, you're going to have to pay a price for that underlying mortgage and then do the wrap above. Well, again, we're primarily targeting people when we're creating a note. We're working with people who cannot get a bank loan, and they know that there's a premium that they have to pay for that. But you have to have a spread between what you're borrowing that money at and what you're laying it out as. You know, you're playing the bank role in that situation. So interest rate is a very important factor. Also, is what's the type of loan? Is it an interest-only loan, a variable rate loan? Is it a fixed rate? Does it have a balloon? All these factors have a direct impact on the valuation of the note itself. We highly encourage to make it a fixed rate return, no, excuse me, a fixed rate loan, 30-year note with the ability for the borrower to pay off at any time. That's what we actually encourage the borrower to accelerate or to pay off as soon as they can. That puts the big chunk on the back end for us. This is particularly true when we are originating our own loans. When we're buying it, we're looking at what the type of loan it is, how long, what's the number of payments that's left, those types of things. Need to also look at, has there been any modifications done to the loan? Have the borrowers fallen behind at some point? Did they have to remodify? Did they lengthen the loan? All right. Was their payment reduced, or was there a trial period in there? So these are all things to look at that can have an impact, all right, on the loan itself. All right. Obviously, one that has not had a modification is more valuable than one that has, but also one who has been modified but now has shown, say, 24 months of on-time payments after the modification, and the borrower is now stable again. That's fine. It's probably the number of payments may have been lengthened at the back end, or there may be a forbearance where the amount of interest that was essentially skipped was put at the back end as well. Remember, you own the paper, so you can adjust however you want to do that when you own that paper. All right, so that covers loan terms. We're going to cover the next section being payment history next.